Here's the comprehensive, deep dive expansion of your material on stock transport orders STO. This content is designed to bridge the gap between a functional consultant and a solution architect, covering technical configuration, business logic, and integration points in extensive detail. 26. STO INTRA and Intercompany. Stock transport orders, STO, represent the backbone of internal supply chains, distinctly different from external sales scenarios. While a standard sales order represents a request from an external customer, an STO represents a request from an internal facility, a plant, to procure goods from another internal facility. However, the moment SD delivery and billing functionality is activated to support these movements, STO transitions from a simple material management process into one of the most integration-heavy and error-prone areas in the entire SAP ecosystem. It forces a collision between the logistics logic of and the shipping or billing logic of SD. Most consultants misunderstand STO because they compartmentalize. They think it is only procurement, or only SD, shipping, failing to see the handshake. Ignore financial timing. They overlook the crucial disconnect between when ownership changes physically versus when it changes financially. Blur legal boundaries. They don't distinguish intra versus intercompany properly, leading to severe tax and audit exposures. Overlook master data dependency. They fail to realize that plants must act as customers and vendors simultaneously in the system. Senior SD consultants clearly understand the golden thread of STO, greater than who supplies, logistics, who owns, legal, who bills, finance, and when accounting happens, controlling. Intracompany STO. Intracompany STO is the most common form of stock transfer, yet it is often over-engineered or under-controlled. Fundamentally, intracompany STO means greater than stock movement between two plants that belong to the exact same company code. Because the legal entity remains the same, there is no intercompany revenue, no tax invoice, usually, and no receivables or payables. There is only logistics execution and inventory valuation movement. Concept. This process is utilized when an organization needs to balance inventory across its own network without triggering a sale. Used when one plant supplies another plant. For example, a manufacturing plant, Plant A, produces finished goods and moves them to a distribution center, Plant B, for final delivery to customers. Both belong to same legal entity, the company code. Example, 1000 owns both the inventory at the start and the end of the process. Internal logistics optimization needed. Simple inventory transfer postings, like T-code MIGO 301, do not provide shipping documentation, packing lists, bill of lading, or route determination. STO provides the formal documentation required for road transport. Examples, hub and spoke. Central warehouse. Hub, replenishing regional warehouses, spokes. Production staging. A raw material warehouse sending components to a nearby manufacturing plant. Repair flows, sending damaged goods from a local depot to a central refurbishment center. Ownership, company remains same. The inventory asset simply shifts from one bucket plant to another bucket within the same balance sheet. No revenue involved, you cannot sell to yourself, therefore no revenue account is hit. The transfer is usually done at the material valuation price, standard price, or moving average price. Types. Not all internal transfers are STOs. It is vital to choose the correct vehicle for the movement based on business requirements. Common intra-STO types. 1. Stock transfer without delivery, only. This is a pure process using T-code MIGO, movement type 301. Pros, instantaneous. No master data setup, customer or vendor, required. Cons, no picking, no packing, no route determination, no shipping documents. Verdict, use only for short distance transfers, example, between two buildings across the street. 2. Stock transport order, STO, with SD delivery. This uses the purchasing document, PO, type UB. It triggers an outbound delivery in SD, T-code, VL10B, or VL02N. Pros, full logistics capability. You can pick, pack, weight check, and generate a bill of lading. You can track stock in transit. Cons, requires heavy master data setup. Plant as customer. Verdict, the standard for most road or rail transport transfers. SD relevance increases only when delivery is involved. If the business chooses Type 1, SD consultants are not needed. If they choose Type 2, SD controls the shipping point determination, route determination, and delivery output types. Configuration. To make an STO work, you must trick the system into treating a plant like a business partner. This is where the integration complexity lies. Key configuration areas. 1. Define shipping data for plants, or SD. You must assign a customer number to the receiving plant. This tells SAP when plant B orders goods, treat them as customer 1002. You must assign a sales area, sales org, DIS channel, division to the supplying plant. This tells SAP when plant A ships goods, it acts as this sales organization. 2. STO document type, standard intracompany PO type, UB, item category, U, stock transfer. 3. Delivery type assignment. You must map the PO type, UB, and supplying plant to a delivery type. Standard delivery type, NL, replenishment delivery. Note: do not use standard sales delivery types, LF, here, or you will break reporting. 4. Schedule line category, standard, NN. This category controls the movement type determination in the delivery. Movement types, the logistics heartbeat. 641 goods issue, 2-step. When the outbound delivery is post-goods issued, PGI, from the supplying plant. Effect: stock leaves unrestricted use of supplying plant and enters stock in transit of receiving plant. It is technically still owned by the company, but it is on the road. 101 goods receipt, performed at the receiving plant when the truck arrives. Effect: moves stock from stock in transit to unrestricted use at the destination. Valuation: stock value moves internally, the system credits the inventory account of plant A and debits the inventory account of plant B. No P&L impact, unless the plants have different standard prices for the same material, which generates a price difference variance. The net P&L impact is 0. Automatic delivery. In high-volume environments, manual creation of deliveries for STOs is a bottleneck. Automatic delivery allows delivery creation automatically upon Santo creation. As soon as the purchasing team saves the Santo, ME21N, the system immediately triggers the creation of the outbound delivery in the background. Used when high-volume transfers, retail environments where hundreds of replenishment orders are generated daily by MRP. Standardized logistics, where no manual gatekeeping or approval of the shipping schedule is required. Configuration. This is often controlled via the auto-delve flag in the specific item category configuration, or via background jobs running T-code VL10B periodically. Example: every hour. Risk: less manual control. If an STO is created by mistake, the warehouse might pick and ship it before anyone notices the error. Must be tested carefully. Ensure that stock availability checks, ATP, are working, otherwise, you will create deliveries for stock you don't have, resulting in back orders clogging the warehouse queue. Return. Returns in Santo are counterintuitive. In a normal sale, a return is a happy process for the warehouse. Stock comes back. In Santo, a return is a logistics reversal. Intra-Santo return. Stock moves back. The receiving plant sends goods back to the supplying plant. Example: damaged goods, excess stock. Reversal evaluation: the accounting entry is exactly opposite to the forward flow. No revenue impact, still no invoice. Movement types: return PO, checking the returns flag in the Santo line item. Movement types: 161, returns PO goods receipt at supplying plant. 671, returns delivery goods receipt. Note: the movement types here, 352, 671, 677, depend heavily on whether you are using a returns PO or a returns order type. Senior insight: Intrasanto. If a consultant talks about greater than selling between plants, greater than type plants, greater than, they are conceptually wrong. Intrasanto is movement, not sale. Why this distinction matters: if you treat it as a sale, you might accidentally trigger tax determination. If VAT is calculated on an intracompany move, the company effectively pays tax to the government on its own inventory, creating a massive cash flow issue and a compliance nightmare. The litmus test: check the company code. If source equals destination, disable all pricing, disable all billing, and ensure tax classification is set to no tax. Intercompany Santo. Intercompany STO is where the complexity jumps exponentially, greater than stock movement between plants belonging to different company codes, even though both companies belong to the same parent group. Example: Samsung Germany selling to Samsung France. Legally, they are separate entities. They have their own tax IDs, their own P&L, and their own balance sheets. This introduces revenue. The supplying company must recognize a sale cost. The receiving company must recognize a purchase cost. Intercompany billing. An actual invoice must be generated. Transfer pricing. The price cannot be arbitrary. It must comply with international tax laws, arm's length principle. Tax implications, cross-border VAT, intrastat reporting, and customs duties often apply. This is senior level SD. Concept. Used when: Plant A, company code A, supplies, example, the manufacturing entity. Plant B, company code B, receives, example, the sales or distribution entity in a different country. Ownership changes between legal entities the moment the truck crosses the agreed Incoterm point, example, X Works or DDP. The legal title of the goods shifts from company A to company B. Result: supplying company books revenue, intercompany sales. Receiving company books inventory. Their stock value is now the purchase price they paid to company A, not the manufacturing cost. Types. Intercompany STO types vary by whether SD billing is used, almost always yes, to generate the legal invoice. Whether pricing is required, yes. Pricing procedure ICAA 01 or custom equivalent is used to determine the transfer price. Whether tax applies, crucial for cross-border, export or import, compliance. Common pattern, STO, type NB. The standard cross-company purchase order. SD delivery, type NLCC. Replenishment delivery cross-company. SD billing, type 4. Intercompany invoice. Return. Intercompany returns are messy because they require a credit memo. Intercompany STO return, reverse logistics. Physical goods move from Plant B back to Plant A. Reverse billing, Company A must issue a credit memo to Company B to refund the cost. Reverse accounting, Company B reduces its inventory value. Company A reduces its revenue. Must be tightly controlled to avoid double revenue. If the return isn't processed correctly, Company A keeps the revenue from the original sale while also getting the stock back. Incorrect inventory valuation. The stock must re-enter company as books at the original manufacturing cost, not the intercompany sales price. Otherwise, inventory is artificially inflated. Intercompany sales and billing. This is where SD becomes critical. It is the engine that converts a logistics movement into a financial transaction. Flow 1. STO created, Type NB. Vendor is assigned to company A2. Delivery created, SD, type NLCC. 3. Goods issue posted, SD or MVMT, type 643. Cross-company. Stock leaves company A COGS, cost of goods sold, is booked in company A4. Intercompany billing created, SDT code, VF01. Billing type 4. Intercompany billing. Payer equals company B5. Revenue posted in supplying company. Company A gets a receivable against company B. Company A books intercompany revenue. 6. IDOC automation. Optional but recommended. The output of the billing doc IV triggers an EDI, IDOC type, INVOIC. This IDOC automatically posts the vendor invoice in Company B's system, FI-AP. Closing the loop without manual entry. Pricing. Transfer price. This is usually a markup on cost plus 10%, or a fixed market price. It is maintained in condition records, PR00, or specific intercompany conditions like PI01. May include markup. Strict audit rules apply here. You cannot sell at loss or excessive profit to shift tax burdens. Tax depends on country. Domestic intercompany US to US. Tax usually applies. EU to EU. Reverse charge mechanism often applies. 0% VAT. Export US to EU. Zero-rated export tax. Automatic delivery. Automatic delivery in intercompany speeds up logistics, essential for just-in-time, JIT. Manufacturing supply chains, where Company A feeds Company B's production line. Increases risk. Once the delivery is created, the stock is reserved. If DeSanto was a mistake, you lock up inventory that could have been sold to a real customer. Only recommended when process is mature, master data, transit times, route determination is 100% accurate, controls are strict, changes to STOs are monitored. Common real project failures. When Santo implementations fail, they usually fail silently until finance closes the month-end books. 1. INTRA Santo treated as sale, symptom, phantom revenue, appears on the P&L that eliminates during consolidation, causing confusion for controllers. Fix. Check the Santo document type configuration. Ensure UB uses a pricing procedure that has no revenue account keys. 2. Intercompany revenue not posting, symptom, goods leave the building but no invoice is generated. Company A incurs cost but gets no revenue. Fix. Check copy controls between delivery type NLCC and billing type 4. 3. Wrong transfer price, symptom goods, are sold to the sister company at standard cost, 0% margin. Fix. The pricing procedure for the intercompany billing must verify that a markup condition, example, PI01, is active and maintained. Tax incorrectly applied, symptom, VAT is charged on an export Santo. Fix. Check the tax classification of the customer master representing the receiving plant. 5. Stock mismatch between companies, symptom, stock in transit limbo. Company A shipped it, Company B hasn't received it. It sits in a virtual black hole. Fix. Implement the stock in transit, SIT report, MB5T, as a mandatory weekly review for logistics managers. Root cause, greater than confusion between movement versus sale. Consultants configure the system to move the goods, but forget to configure the system to sell the goods financially. How senior consultants think about Santo. They do not start with T-codes. They start with the legal entity structure. They always ask, 1. Same company or different? Determines doc type, UB versus NB. 2. When does ownership change? Determines Incoterms and title passage clause. 3. When does revenue post? Is it on goods issue or on customer acceptance? 4. Which valuation applies? Does the receiving plant keep the original price or adopt the new transfer price? 5. Which tax rule applies? Departure country tax versus destination country tax. If these are clear, STO design is straightforward. If these are ambiguous, the configuration will fail. Mental model to lock in. Simplify the noise. Use this binary filter, intra-Santo logistics only. It is a movement. No cash changes hands. The pie stays the same size, you just move a slice from left to right. Intra-Santo logistics plus finance. It is a sale. Real cash or intercompany debt changes hands. One entity gets richer, the other gets poorer. Final perspective. STO is the ultimate test of an SD consultant's breadth. It is where logistics, shipping, SD, inventory valuation, or FI, accounts receivable, FI, and tax intersect. Junior consultants execute transactions. They know how to create a PO and do a GR. They panic when an IDOC fails. Senior consultants design Santo so that logistics flows. Trucks are not waiting at the gate because paperwork is missing. Accounting is correct. COGS and revenue match in the same period. Matching principle. Tax is compliant. Customs documents are generated automatically. Audits pass. Every movement has a corresponding financial document. Misunderstanding Santo causes silent financial errors. A missing external sales order is noticed immediately. The customer screams. A missing intercompany invoice might go unnoticed for months, leading to massive write-offs at year-end. Say next when ready.